Traders at Access Bank say they expect the Treasury Bills market to close the week bearish due to the thin liquidity levels and the biweekly retail auction debit. Kinskin Ukeje, an FX dealer at Access Bank, joins us now to discuss the state of the markets here in Nigeria. Kinskin, thank you so much for your time. So you're expecting a bearish trend to unfold. How do you see things panning out after this retail auction?
Yeah, we should see the bearish trend sustain even up to the beginning of next week. We've seen market liquidity being ripple from Tuesday, where it sank into ripple of about 33 billion. It has worsened, albeit yesterday system was in a ripple of about 355 billion. So the bearish sentiment should be mostly on the short end of the curve, where traders will sell in order to cover their obligations and to fund for the retail debit to be held today.
It does appear as though liquidity has been tight for a bit, but those rates are still relatively low, if you ask me, given where inflation is at. Do you anticipate perhaps in the months to come that we would see a re-rating of T-bills, specifically T-bills and maybe even bonds, to much higher yield levels?
Yeah, the outlook for the rates on the T-bills and bonds still would likely trend higher, but this is all factored on the general system liquidity at each point in time. Going into next month and in the upper week, we should see better maturities, as the outlook for next week will have a lot more improved maturities that will hit the system, and that should maybe better our system liquidity in the coming weeks.
And in the forex market, we're seeing the NAFEX rates depreciate by about 42 kobo to about 419, but still relatively stable if you ask me. What do you think is driving that stability? Is it the oil price, or are we seeing supplies of foreign exchange from elsewhere?
The sustainability in the FX market is really driven by the Apex Bank sustaining their interventions, especially to FPIs and also in the visibles and the SME windows. We've seen them sustain their interventions in those spaces, albeit we continue to see demand outweighing supply of funds in that space. But I just think it's more of a market leveling up at that point at the 419, 420 levels, and it hasn't broken beyond that point. All right,
coming back to the bond market now. How do you see the yield curve changing moving forward?
Yeah, we've seen a lot of bullish sentiments in the bond market. Even at the auction, we've seen unmet demand filter into the secondary market. We've seen the 2025 bills trading at sub 10% levels, from where it closed at 10.1 in the auction that was held this week. On the Eurobond space, we've not seen that reaction as much compared to inflation and the Fed increase in rates. We've seen more resistance in the Nigerian Eurobond space, and we've seen it trade at 11%, which is even more attractive than the Nigerian bonds.